The levers of power, fiscal versus monetary policy. Today we are understanding something very powerful. Macro is not random, it runs on levers. There are two main levers in every economy, fiscal policy and monetary policy. These two forces shape growth, inflation, asset prices, jobs and markets. If you understand these two, you understand most of the macro. So when the economy overheats or slows down, people ask, who fixes this? The answer is not one, it is both. On the left, fiscal policy, it's the government. On the right, monetary policy, it's the central bank. The government controls taxation and spending. The central banks control interest rates, liquidity, and money supply. They operate separately, but their impact overlaps. It's never just one, it's always both. Think of economy like a machine. This slide gives you a mechanical view. Fiscal policy controls capacity and power. It decides how much fuel the engine gets. Monetary policy controls speed and flow. It decides how fast the car moves through the accelerator and brakes. So remember, government is equal to engine power and central bank is equal to speed control. What fiscal policy actually does? Fiscal policy puts direct demand into the system. When the economy is weak, government can increase spending, cut taxes, give subsidies, build infrastructure. This is called as fiscal expansion. It increases incomes, job, and business activity. But if inflation is high or debt is rising, government can cut spending, increase taxes. This is fiscal tightening. Fiscal policy is visible, is structural, and is slow. It changes the real economy directly. What monetary policy actually does? Monetary policy works differently. The central banks does not build roads, it changes the cost of money. When growth slows, they lower interest rates, inject liquidity, make loans cheaper. This is monetary easing. When inflation rises, they raise interest rates, drain liquidity, slow credit creation. This is monetary tightening. Monetary policy is fast, market driven, indirect. It works through expectations and asset prices. So let's understand the structural difference. Fiscal policy is spending and taxation. It pushes direct demand, impacts real economy, slow and heavy. Monetary policy is interest rates and liquidity. It adjusts cost of capital, impacts financial markets more, and it's fast and fluid. One affects jobs and infrastructure, the other affects credit and asset prices. So when fiscal expansion and monetary easing are happening together, government spends and money is cheap. This usually supports stronger growth. And when fiscal discipline and monetary tightening happens together, government cuts back and money becomes expensive. This usually helps control inflation. So when both levers align, the system is stable. But when policies fight each other, market loses clarity. Example, government is spending aggressively, but central bank is raising rates. This is like pressing the accelerator and the brake at the same time. Result, unpredictability, volatility and confusion. Markets struggle to price the future. Macro is not about opinions, it is about understanding. Who is pulling which lever? Is the government building capacity? Is the central bank draining liquidity? Once you ask these questions, price action starts making sense. This framework is not a theory. Investors constantly watch budget deficits, government spending, rate decisions, liquidity trends. If you understand the policy mix, you understand the direction of growth, inflation, bonds, equities, and currencies. That's how we see it. If you found this insightful, do share this with your friends and family and follow my channel for more such content.